The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group. Our show is Winning in Retirement. It's our radio podcast that we put on each and every week. Here with me today is Paul Franco, financial advisor from Akers Financial Group. Welcome, Paul Franco.
Hey, Brian. How are you today?
Very good. I'm glad to have you here. As a financial advisor, you've been working many years with Akers Financial Group and doing a great job with our clients. And I know you and I have been studying since 4th of July.
Sure have.
And so we had to do this show. Today's show is One Big Beautiful Bill and You.
Yeah, it's beautiful, right?
Well, I like the silence. One Big Beautiful Bill and You. So the idea is this bill that was passed and signed into law on Friday is now something that we need to pay attention to see how it applies to you.
Correct.
This is not a political show. It's not going to be a show based on we're going to try not to base on opinions. We're going to base on interpretations of what we see so far.
Right. And that's the battle, right, Brian, is that ultimately we interpret it and then likely there will be some version of guidance to help make it more solidified in some ways. You know what I mean?
You know, they write a 1,000-page bill with a lot of things in it. And in there, you have different sections, and all those sections apply to different parts of the IRS law and apply in a lot of other government agencies, all kinds of ways. Every one of them have to interpret what was meant by it and how to apply it to even like a tax form. When it comes to the 2025 taxes, you have to apply this to that tax form and knowing what it really means. And then you have people describing what it is and maybe not telling the total answer when it comes to what's really going on with this One Big Beautiful Bill and You is our show.
Right. Yeah, it's funny that if you listen to some industry leaders, that the tough part is that they say that the new laws, like we haven't even fully caught up from Secure Act and then Secure Act 2, and then now there's talk of a maybe Secure Act 3 sometime down the road, and then they just keep coming in with all these different rules, and there's not enough time to catch up. It's kind of funny.
Yeah, but this one is on new rules. Now, many of you might know I coach high school basketball, and so every year, October, November, we have a referee meeting. That referee meeting, they'll come out with new rule books. Yep, basketball is the same game, but they have a new rule book. And they go over any changes in the basketball refereeing for high schools around the country, and then how they're going to interpret it, and then the concentration for that year.
Right.
Every year. So I see when the government has a new law, I treat it the same way as coaching. All right, so these are the rules. How do I change our strategies to make it better for my players? But in this case, to be better for our clients.
Right.
And so I get excited because, hey, we got new things to read through, new things to apply, and we got to make this fit into the overall winning in your retirement by making wise decisions to help you keep more of your own money for a lifetime.
Yeah, it's so important. And because the rules change, we have to be specific in our planning to do the things now and not be backwards looking. Like we have a certain time frame, we can do a lot of these changes. We can work through that in your plan. And ultimately, it's just like you said, Brian, like coaching, like you're listening to the rules, you come into that, have that meeting, and then your job is to interpret that and then guide your players into making it give you the most optimal outcome.
Oh yeah, like they changed the bonus foul rule for the first half, second half, and made it 5 fouls per quarter.
Really?
It's really changed the rules because you have no one-on-one anymore. So at the end of the game, if you foul, they get 2 shots.
Yeah.
It's brutal. So the concept is you want to get to the line, so you drive more early and often in high school basketball to get to the foul line sooner. So you hit the 2. Sorry. Let's get back to the One Big Beautiful Bill. Now, the reason we're using that name is that's what the name of the law is. We could call it Law 119-21. We could call it the bill or OBA. Is that the other? OBA. OBA. Not ABBA. It's OBA. OBBBA.
Yes.
So when we say new law, new rule, we mean all that. It was signed on July 4th by the president, and there's many things in there. Some people will hate it because they would hate it. Some people will like it because they like it. We believe you have to read it to understand it, to then apply it. And then the opinion is you might like pieces of it, depending on how it applies to you. Today's show is going to cover parts of it. We're going to cover what we know at the moment based on what we've read, what we've gone through. And Paul and I have prepared for this, so we're going to do our best to try to cover it. Now, I want to have a basic premise to start, Paul, and that is this. When we see financial planning, we believe at Akers Financial Group, you have to apply taxes, your investing with a purpose, your insurance, all of it together in full financial planning. Now, that's very, very important because we believe that when the rules change, it's a great time to review with a financial advisor that looks at everything.
Yeah, that's exactly right. And that time to review is not to start that review in 2026. It's to do that review now to make sure that we're taking advantage and understanding these new law changes and how they apply to you specifically. Because the reality is that when we see the news and you see, all the news articles of spitting out, just something that gets the most clicks, something that gets the most attention, that doesn't really dive deeper into how does that apply to you. And then, ultimately, our goal is to try to weed through that and determine, okay, what is true versus what is not true, and then what applies to you versus what does not apply to you.
Yeah. So, all right. So today's show is not intended to cover it all.
Right. It can't.
In some cases, we're going to have to wait for an IRS interpretation to truly know how it would work on your return. And then sometimes they get a do-over, like the Secure Act, they had to redo and reinterpret because once people really dive in, they're going to find options and changes and angles and opportunities. So let's start with this. The Tax Cut and Job Act of 2017 basically created tax brackets and lowered them down, and then also made standard deductions and personal exemptions all get put together, giving us a large deduction, so very few people itemize anymore.
Yeah, it's a huge benefit. In reality, had the Tax Cut and Jobs Act expired at the end of this year, it would have created a huge new tax bill for individuals. Right,
so that bill, the Tax Cut and Job Act of 2017, has been made permanent through this bill. That's the number one the big idea of this is that makes it a permanent, meaning that these tax brackets we have in 2025 are going to stay the same. Now, they're going to escalate with inflation over time, things like that. But generally, the fact that they're permanent means that we're lower brackets into the future. Now, we have to have some caution to that, right, Paul?
Right. I was going to say, what's your opinion on permanent? Because in reality, is that truly permanent?
The word permanent is different than expiring. So we've been having radio shows since 2018 about sunsetting. Let's get your Roth conversions done, do all these things now. We know what the law is. We don't know the law in the future. Well, the idea is this. The corporate tax rate was permanent back then. The personal tax rates are now permanent under this. Right. And the question is, how permanent's permanent? I believe the law, if you read into everything, there's this 4-year period of the extras they added in. And in 2029, the pieces go away, but the tax rates stay the same. I believe ultimately that tax rates could go up in the future. I want us to understand, is there an opportunity for you and your family to pay tax now and never again? And that's why it's a great time to review where you are right now to understand, hey, if these tax rates are reasonably low compared to history, can we take advantage of this to benefit my family for a lifetime?
Absolutely. The reality is that if taxes go up in the future, we would have wished that we would have sat down and filled up our lower tax brackets. Mm-hmm. Brian, fill them up at the lower rates that we're in, pay the tax now and never again. And so we do have an opportunity to bridge that longer now. They've extended it. Our sunsetting didn't end it this year. Now we have more time to fill up those brackets and pay those lower taxes.
What you'll find out throughout the bill is there's limits on income. Once you get to over certain incomes, and there's all kinds of variable income levels that they look at, all of a sudden you lose the deduction, you lose these exemptions. So our idea is this. If we can get underneath these bars, these poles that are income limits, where underneath it you get a deduction, above you don't, we got to watch IRMA, we got to watch tax brackets, we got to watch every deduction, the new Social Security, senior tax, personal exemption, all these things going on. How can we make sure that for a lifetime we pay the least amount of tax for a lifetime? And that's by managing your success well.
Yeah, imagine somebody, and we'll go through these in detail because that was a lot of the studying, right? Brian was trying to figure out each of these different income levels under each deduction because they're not all the same. It was definitely something to read about. But the tough part is in planning, if we're getting close to those limits, what can we do now that we can adjust so that you do maximize that deduction or you do have extra room to do Roth conversions? What can we do now? We don't want to be looking at the tax returns in April and then saying, oh, I wish I went a few $1,000s over this limit and now I didn't get to take advantage of that deduction. That's the planning we want to do now. That's why we want to review with you now.
All right, so here in the first quarter, we're introducing the One Big Beautiful Bill Act. We're calling it OBA. Is that?
I think that's fair.
The OBA, the new law. It's Law 119-21. As you read through it, 1,000+ pages. It's has its interesting moments. There's some general things that we want to apply. One of them is that the Tax Cut and Job Act tax brackets are permanent. That's a big deal. And that gives us opportunity to pay tax now and never again, and to try to manage these brackets for you.
Absolutely.
So depending on where you are in your personal situation, we'll have a different answer. I believe the concept would be hey, let's see how much tax we can pay now, right, so that we never have to pay again.
Well said. Yeah, it's the whole idea. Pay the least amount of tax in your lifetime.
Yeah, so guess what? That means you keep the rest.
Correct.
And that's
more to your family.
Not a bad concept. So this applies to a lot of people, not just retirees. We're going to cover this throughout our show today, trying to apply new laws, new rules. And what should we do as financial planners for our clients? What should our clients be doing? The answer right now is a great time to review is the key answer that we're trying to get across. At Akers Financial Group, we're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill, clients all around this Mid-Atlantic region, all around the country, even a few around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your free meeting with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. What cards are you holding? We'll talk about that when we come back.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. Here today is Brian Akers and Paul Franco from Akers Financial Group. We are financial advisors from Akers Financial Group, and we put on this show, Winning in Retirement. It's our radio podcast. We invite you to go to our website at AkersFinancialGroup.com and check out our radio podcast tab. Listen to this show and many other shows right there, or on your local, or not local, on your apps, your podcasts, anywhere you can find Winning in Retirement. You can catch up on what we're talking about. So if you miss anything, just head right there. All right, today, Paul, welcome to the second quarter.
Yes, thanks, Brian.
Paul Franco is a financial advisor at Akers Financial Group, and him and I have been studying the One Big Beautiful Bill. So we came up with this show called The One Big Beautiful Bill and You, and we're talking about this, and we're going to use, what's going to be the word for the bill?
OBA.
OBA. O-B-B-B-A.
O-B-B-B-A, yes.
That's like, and it stands for the One Big Beautiful Bill Act.
Act, yes.
Right? So the new law, new rule, anytime we reference that, that's what we mean. We're just talking about that one. We're not diving into all the 1,000 pages. We're doing one topic at a time today. Our concept is this. It's a great time to review your situation and how it's applied to the new laws. As a basketball coach, every year we get a new interpretations of the rule book. We have a meeting with the referees. They tell us. We then take that information and then design game plans around the strategy of the new rules. Same thing in planning. Absolutely. Financial planning is coaching, and even basketball coaching is coaching. So we enjoy working with each and every client as we come up with what's best for you and your family. So this new rule, there's this one saying we're going to start out as this. What cards are you holding? Yep. Now, that's an interesting topic, right, Paul?
Sure is. It sure is, because how does it apply to you?
Well, I got to do this. If you're going to play the game, son, you better learn to play it right. Are you old enough to know that song?
I sure am.
All right, I can't sing like Kenny Rogers, but Kenny Rogers and the Gambler had a great line. You're going to play the game, son. You better learn to play it right. So imagine the cards that you're holding is your financial fingerprint. It's where you are today, financial fingerprint. As a financial advisor, we need to get to know you, to know what's going on. How do they get to know us, Paul?
I was going to say, this is what we do in the sense of when we sit down and review with you, we identify what your financial fingerprint is, where you're at now, and then ultimately it's getting to know you, getting to know what your goals are, when you want to retire, if you want to, if there's legacy planning, whatever your goals are, we get to know you to help us be able to give you the best level of advice that we can. And that's how we get to know you and ultimately build out your financial fingerprint. That's the whole idea.
All right. So on our website, akersfinancialgroup.com, there's a document tab right under there. It's a list of items we'd like to have you bring in. You can bring in the first meeting where we get to know each other, see how we can work together. We need that information to respond on, hey, what can we do? How can we make it better for you?
Yeah. Sometimes those first meetings, sometimes we don't even talk about finances as much as I just want to get to know you.
All right. So cards, the reason the idea of cards is if you have a collection of what you've done in your career and life, then we have choices. So if you have one thing like Social Security only in a retirement, then most likely you're part of the 64% of Americans that have Social Security that don't pay tax on Social Security at all. Right, Paul?
Right.
Now, if you're in Social Security only, we think that you need to not retire that way. Right. You need to have other investments, other money set aside so you can have other buckets of money for your lifetime. Many times I call that cows, other things in your herd of money you save, lots of other ideas. But when we have these cards and we got to learn how to use them, we have to understand the taxation of each account and the fact that sometimes we put ourselves in a future hole tax-wise by being too successful.
Right.
So that when we become a multi-millionaire 401k person, and we've been in it a long time, you might have a lot of pre-tax money, and then by 73, 75, you got to start paying tax, need it or not.
Yeah. And that's exactly why we want to get to know you. Understand that we are the experts. We're the experts in that planning, in that type of planning, so you don't have to do it on your own. It might sound overwhelming, the concept of paying tax now and never again, but we show it to you and we build it out in this plan for you so that you don't have to do it on your own.
Mm-hmm. Right. So I know you hear lots of things out there, and what you hear is that the tax bill is just for wealthy people.
Yeah.
Now, most of the extras in the tax bills has income limits, and so a lot of the smaller options are not for wealthy people. But the core of the bill, in my opinion, the core is the tax brackets. Now, we want to talk about tax brackets so you understand what that is. So, Paul, can you give us a basic idea of what tax brackets are currently?
Sure. Well, so as part of this extension of the Tax Cut and Jobs Act, our highest marginal tax rate is 37%. And that is higher than the 39.6 that would have been had we expired at the end of this year and gone back to those pre-tax 2017 Tax Cut and Jobs Act brackets. And so the highest marginal tax rate is 37%. For most people, they fall in the tax bracket of somewhere in that 22 to 24% range. And so what happens is, for like a married file joint in 2025, the $96,950 all the way to $206,700 is taxed at the 22% bracket. That's on the highest end of that level. So the tax brackets are tiered. And so that's beneficial in the sense of you're not paying all the tax at the 22% bracket. But then that next dollar above that $206,700 here in 25 is taxed at the 24% bracket, and that's all the way to $394,600. And so in planning, what we try to do in maximizing your tax bracket is pay tax now at those lower tax rates and never again. And the funny thing, Brian, is I actually have a chart showing what the level was back in 2017. So if you want, I can go through that too, sort of give you an idea on what those tax rates were in 2017.
Well, let's go slow.
Sure.
All right. So tax brackets, you're doing the married filing jointly.
Right.
And you're basically, you use the word tiered. So it's like going up steps.
Correct.
And there's like a 0%, 10%, 12%. And then when you take a next big step, it goes from 12 to 22.
Big jump, yep.
But only the dollar that's in the 22% bracket is 22. The first other money is all at the other steps, right?
Correct, right. So imagine if somebody is at the 22% bracket and they have $100,000 of taxable income, they do not pay tax on the full 22% for that $100,000. That's where we get something called an effective tax rate. An effective tax rate is actually the real tax rate that you pay the tax on, that incorporates all those tiers.
Yeah, so you have steps, and those steps go to brackets 22 and 24. In my opinion, 22 and 24 are almost the same number.
Yeah.
It's not a big change in your taxes. The big change in taxes is when you get above $250,000 federal. There are some add-on taxes. Some call it the ACA tax on investments of 3.8, and there's some other things that go away. So you get hit with more and more tax the more money you make. State of Maryland has the new tax rates for people making $200, $500, which we'll cover in another future show.
I was going to say.
We're not covering that today, but the general idea is this: knowing your situation. The more money you make, like let's say that you're at $500,000 or more now, you're doing very well in your career combined with your spouse or just by yourself, whatever's going on there. You have this incredible income coming in and you're at this high bracket. I think it's okay to consider Roth IRAs.
I agree.
And the reason is that if we have a plan to always be at the high bracket, why not take advantage of something never being taxed again? So I believe higher income people have to look more than ever into the Roth IRA conversions and contributions at work and mega Roth concepts and backdoor Roth ideas.
I agree. Yeah.
All fancy planning, all cool things, but we're not going to tell you anything about them except that it's a great time to review and find out how this applies to your situation.
Exactly. Yeah. I mean, the reality is that those individuals, the problem is that those are conversations we have, right, Brian, is in retirement, I want your lifestyle to stay the same. I don't want you to have a lesser standard of living in retirement. Instead, I'd rather it go up some in retirement. That's the idea. So you actually, to the surprise of some people, you might actually be at that bracket for a longer period of time. And so that I agree wholeheartedly that Roth IRAs, you can't rule them out completely. We have to see if it makes sense in your situation.
Yeah, now Paul teased about going back to the 17 rates to show you the difference. And then the thing is this. Guess what? We don't have to worry about it.
I was going to say, yeah.
So it's permanently these new rates until things change.
Right.
My bottom line as a financial planner is worst case scenario. I think there's a window of time where this is the law. It might be 4 years, might be 8, might be 10. Who knows how long? The best thing in your financial life, in my opinion, is to consider, can you pay tax now and never again? Does a Roth conversion fit into your ability here to basically make your money better off down the road?
It's that tax-free growth, Brian. The tax-free growth is a huge benefit. Mm-hmm. That's the big benefit of doing the Roth conversions and the Roth IRA. And then ultimately, right, if taxes are higher down the road, we don't know for sure, but they probably will be. Mm-hmm. We'll be very thankful and glad we did pay the tax now and never again.
There was different proposals when they were trying to come up with this bill. And one way to offset, someone proposed having a 401k tax internally inside the 401k to basically peel out some tax money from the retirement plans.
Oh my!
So I've my whole career, I've always thought that they're going to look at these trillions of dollars in retirement money and they're going to say, can we have some at some point in time?
Right.
So I don't think that's going to be permanently off the table, but when they're trying to offset the bill. The sad part is this bill, it basically is being offset by debt, more debt. So that's a totally different subject, but the fact that it's being offset by debt and they're hoping that growth and everything else might cover it over time and some other policies changing. I hope it all works out great. But generally, I believe that we have to look at this tax bill as the idea is, what can we do now to make it best for you and your family? That's why it's the best time to review.
And sit down and review. Exactly. Sit down and review and see how it applies to you. That's the whole purpose.
So this quarter was about, you have the cards and how are you holding your cards, and you got to learn how to play them right. That was the whole concept of this quarter. Now, by talking about this, Paul, we do a lot of financial planning. We enjoy financial planning.
We love financial planning. We sure do.
Now, do you love the planning part or do you love the outcome of it?
I love both.
Yeah.
I mean, I think the planning leads to the outcome, and that's what's so important. And then when you reach that outcome, it's a beautiful day. It really is.
Yes, I've had it since the law came into effect last week. I had a meeting with one of my clients. On my table says winning in retirement. And I said, you guys are winning in retirement so well that the new law is not going to help you any. And I tried to explain how success led to a point where you've been a great saver, built wealth, but these extra deductions and things are not going to be there to help you. Now, what we want to do is this. We want to sit down and talk to you about your exact situation. So we have this free meeting where you can sit down with one of our team of advisors and talk about your financial fingerprint. Go ahead and give us a call at 833-WIN-RETIRE. Schedule an in-person meeting to talk about it right now. That's 1-833-WIN-RETIRE. Or go to our website, akersfinancialgroup.com, and scroll down and schedule a meeting right there. Will you pay tax on your Social Security income? We'll answer that question when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner practitioner, president and founder of Akers Financial Group. And we welcome you to our show's second half of Winning in Retirement. Today with me is Paul Franco, J. Paul Franco. And we enjoy having J. Paul Franco, MBA, financial advisor from Akers Financial Group. Him and I have been studying this week the OPA or OBA.
The OBA.
Yeah, OPA. OPA is a grandma, a German grandmother. I'm sorry.
I'm getting OBA. Mixed up with OBA and ABBA.
ABBA. Yeah, we can't sing like ABBA. OBA. OBBBA. Right. One big, beautiful act. And you is the name of our show today. Because we want you to understand that when they change rules, change laws, and they become permanent laws, how does it affect you and your financial planning? That's what we worry about. Our goal isn't to talk politics, isn't to tell you, oh, well, this side's right, this side's wrong. The thing is, well, these are the new set of rules to work within. How can you benefit the most over a lifetime? And how can this truly help you? So far, we've covered the basic idea that the Tax Cut and Job Act, the tax brackets have been made permanent. We like that the best, of course, right?
Absolutely.
Now, this quarter, we got to cover the big topic of, will you pay tax on your Social Security income? Is this true? What's really going on here? Paul, why don't you go ahead and begin?
Oh, boy. That's a loaded question.
All right. Basically, let's start with this.
Right.
Pay no tax on Social Security income. Is that true, that no one pays tax on Social Security?
That is not true.
All right. We're talking about federal tax, of course.
Correct.
Now, Maryland, we don't pay tax on Social Security income since Hogan changed the rule in 2022.
Right.
Federal taxation is possible, right?
Correct. Yeah. And with taxation of Social Security, there is no chance where you pay full taxability on your Social Security. The highest amount you could pay tax on is 85% of that benefit. So that's one key thing to know in Social Security planning.
So if you made $20,000, that's like around $17,000 would be taxable.
Correct. And $3,000 would be technically tax-free on the federal level.
Yeah. All right. So let's cover the basic idea of what's in the actual bill for Social Security. Your Social Security, it doesn't say in there Social Security tax not taxable.
Right.
What happens is they came out with what's it called, a senior personal exemption? Is that the wording?
They're calling it a temporary senior deduction or senior tax deduction.
All right. So the word temporary, it's good through 2028.
Yep.
So that means for 2025, 26, 27, 28, there's a senior personal exemption, right?
Correct.
And what is that?
Right. So what it looks like and how we read is that ultimately that per individual age 65 and older.
Yep.
Okay. So age 65 and older would get an additional deduction in addition to what their standard deduction is,
right,
of $6,000. And that's per person. So if it's a couple, it would be an additional $12,000 of an additional standard deduction.
Right.
Not a removal of taxation on your Social Security, but just an additional deduction.
And what we also read is that this is an exemption for checking the box, you're over 65.
Right.
And that's against income, even if you're not drawing Social Security.
Correct.
Or if you never had a Social Security at all.
That's exactly right. So it applies to 65 and older. And if you're waiting to draw till your full retirement age, which might be 67, or you're waiting to draw till 70, which is the latest you can draw, you can still take this extra $6,000 or $12,000 if you're married as an additional standard deduction.
So this is an income deduction, not a tax credit.
Right.
I was hoping it would become a tax credit, which I love credits. Not,
oh boy, yeah.
Deductions are nice, but so basically, the stats go like this: 64% of people before this law came into effect, 64% of people drawing Social Security don't pay federal tax, and then now they're saying some websites say 90%. The reality is more close to 88% based on a Kiplinger letter, which I like Kiplinger a lot, their websites, the information when it comes to data and facts. And in the CFP board, the facts, the idea of 88% is the estimate would not pay tax on their Social Security with this new exemption.
Right. It's a big deal. It truly is a big deal, but it also opens the ability for us, Brian, to do a whole new layer of planning where we can have an additional, if you're married, $12,000 where we can do some version of planning for.
But the word but is here. The reason is that it's a 4-year temporary rule and it has income limitations. For individuals, the income limitation is $75,000 of income. And then for married filing jointly is $150,000, and then it phases out above that.
Right.
So between 175 and I forgot, it goes to from 75 to 175 for single and 150 to 250 for joint. It phases out. So if you make more than 175 single, more than 250 joint, forget about it.
Right.
This senior tax exemption does not apply.
Correct. Yeah. And it ultimately, the vast majority of people, and that's where you get the statistics of 88%. 88%, maybe 88% won't have to pay tax on their Social Security, but that's more of a deeper rooted problem, in my opinion, Brian, in some ways, of that's the vast majority of people that are drawing mostly off of just their Social Security. So it does impact them quite a bit.
Yeah. Well, honestly, if you're just drawing Social Security, you're probably not paying tax.
Already, correct.
Yeah, already and probably never in the future because you really there's not enough income there.
Right.
I think Social Security only as your retirement plan is a basically poverty answer. It's not going to be the right answer. So the younger you guys are, the younger you're out listening to this tax law is interesting. It's 4 years, might not even apply to you mentally, but understand that if you do Roth IRAs now, you never pay tax again. That money set aside, it's your money to live on. Our basic thing to learn from this is Social Security should not be your retirement plan.
Right.
It should be part of it, but not all of it.
Absolutely. And it also builds out the idea of, can we create some version of tax-free income in retirement, which is the idea of doing the Roth IRA.
Absolutely.
Because again, that might mean that only your Social Security is what's showing as taxable, because that's a big benefit if you're taking tax-free income.
Right. So Social Security income, do you have to draw to get this exemption? Our understanding is no. If you're not drawing Social Security, but you're over 65, you get this $6,000 per person exemption now.
And wouldn't that, and who knows, maybe they'll write some version of IRS guidance to change that, but that's how the rule reads, is the reality.
Yeah, so that gives us thoughts such as, hey, they gave me another deduction. Can I sneak $12,000 underneath $150,000 to basically have $12,000 Roth conversion and $12,000 offset by the deduction, and I have a net Roth conversion with no tax? That's fun and possible.
I was going to say, we talked about this before, right off air. We were talking about different strategies. And Brian, that's a great strategy. Imagine it's an additional $12,000 you could possibly convert to Roth. That's a wonderful idea.
So if you're under 150, I think it's a great deduction. If you're married, filing jointly, under 75 single, it's a great deduction. If you have room underneath there to do other tax planning, it's a great time to review. Great time to look at where you are, project your income, and see what we can do. Sometimes what we got to do is go from taxable interest to tax-free interest so you can bring your income lower so you can do more planning.
Right.
There's a lot of financial planning topics here, but this quarter is all about Social Security. Now, there is news out there saying that this is affecting the Social Security Trust Fund, and I want to cover what I found on the internet.
Sure, please do.
All right, so I like playing around with AI. So I type in information, up-to-date information on the signed bill, OBBBA, and they gave the information, and it says that one of the lines on the AI search says that the Social Security deduction is going to affect the trust fund.
Sure.
And so I click the button, and it takes you to the congressional office that does the accounting to check it out. And the article that it references to give the information through the AI search I did is talking about the Fairness Act that Biden did towards the end of his presidency, where he allowed Social Security for those that had They had their own pension where they never paid in Social Security, but yet they worked outside. And for many years, they never got all their Social Security. Right. And so they did this Fairness Act where they basically give them more Social Security, paid them back for last year and everything, lump sum. I thought it was a decent, right thing to do, but that hurt the trust fund. And that's what that chat GPT, whatever version I was using, you hit that button, and what happened was it talked about that affecting the trust fund by 6 months to a year, not this bill. A tax exemption is a tax exemption. It's not under the Social Security Trust Fund accounting unless they have some other piece that we haven't found yet that throws it right back in. I'm not sure.
But isn't that so funny, Brian? Like, we now in our world of trying to gather as much information, and chat GPT, whatever version of AI that we can use as our assistant and to help us, is not always accurate, and it gets you to the wrong place.
It searches everything out there, right? So that's everything. And the hardest part is we have to dive in and read the law, go through those lines like we did. That was hard to find the actual finished law. Right. We had to find opinions from different sources that we love to go to. We also had to bring that together. And then what happens is this applies to planning. We think it's a great time to review because this is something you need help with. I believe we need to understand, hey, are you near 150? Are you near 250? Are you near 218 where you have to watch IRMA? What's going on in your financial life?
Right. And the tax planning that we do, Brian, it's like we almost have to go back and adjust our estimates. You know what I mean? As far as especially why it's so important to sit down and review. And what we love to do with our clients in tax planning is work through towards the end of the year, October, November timeframe of really sitting down and getting a really good feel at what your income's going to be. If you're over 65, then ultimately now we have a little more room where we can do more tax planning and be more, give us more strategies and ideas.
All right. So in Kiplinger had an article and they had this thing about FACT, and I really liked it. I want to read that. It says the OBBBA doesn't change Social Security taxation directly, makes no changes to the Social Security program. The new law enacted on July 4, 2025 provides a temporary income-based bonus over 65 tax deduction rather than a full repeal of Social Security benefit taxes. That deduction boost could, for some, indirectly impact how much Social Security income is subject to tax. I thought that was just very well written, and it's exactly the interpretation that we read in there. Now, throughout the show, we're talking about the IRS going to come in and read and apply. Hey, things can change, and we'll come back out with that when it comes to changes. What do we do about this now? Hey, know where you are.
Correct.
That's the best advice, is figure out what bracket are you in, how close you are to 150, to 250, to 175, 75, single, married, filing jointly. All these options. Make sure you know.
Absolutely.
It's a little crazy, though, Paul, because there's lots of numbers I just spurted out.
It sure is, but it's the planning and the reviewing aspect where we sit down and review with you. You don't have to do it all on your own.
And the idea is this. We want you to be winning in retirement, where the best part of retirement is where you get your time back. You decide how to use it. Let Brian and Paul read the tax bill. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. How much salt is in your financial diet? We'll talk about this when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. It's Brian Akers and Paul Franco from Akers Financial Group. This is our radio podcast. You can go to our website at akersfinancialgroup.com and check out more information about our talk today. But call us. It's time to do a review. It's a great time to review where you are. We start with your financial fingerprint and then figure out how these things can affect you so we can build strategies for you and your family for your money to last a lifetime. You ready to go fourth quarter, Paul?
Let's do it, Brian.
Hey, we're going to hit a lot of topics this time.
I know. I'm going to see how we do, right?
Pull over the car, get your notebook out. You got to write some stuff down. All right. So I'm starting out with this. How much salt is in your financial diet? All right. Go with that joke, Paul.
Oh, boy. So the concept of SALT, right? So SALT in tax planning stands for state and local tax.
Yeah.
And so the interesting part is, as part of this one big beautiful bill, what happened was it actually, for people below, I believe it's $500,000 is the income limit, it increases the SALT cap deduction that you can itemize. It increases it from $10,000 to $40,000. And that phases out as well over to $500,000. But again, Brian, that is only for the next 4 years, for 25, 6, 27, and 28. That is set to expire in 29. So that's the SALT that we're talking about. And that's so funny. We talk about it sometimes with clients just in general. Oh, well, watch your SALT tax. And they look at you like, what do you mean? Like, and then, oh, I'm sorry. State and local tax.
Well, the reality is 97% of Americans don't itemize anymore because the standard deduction and the personal exemptions got all combined and made a very large deduction. I think deductions for married filing jointly is $31,500. Just generally, without adding any extra deductions for being over 65. And then the new one, which I think is going to be a separate entry somehow.
Right.
The idea of in individual is $15,750. But if you have a house and you have real estate taxes and then you pay Maryland taxes, if that's over $10,000, you only can deduct $10,000. That was one of the reasons you couldn't itemize.
Right. That's a huge benefit, right? Is that idea of, for those who are paying all that mortgage interest or give quite a bit to charity or take high medical deductions, now we can deduct more on our state and local tax side. Yeah,
especially if you're over the 10,000 limit. So now the SALT's going to let that be up to 40, but then your income has to be below 500,000, which makes it work out. So certain situations it's going to be a good thing,
right?
But only if you get above the standard deduction full amount of at least $31,500 on married filing single. So married filing jointly. The single people, I think this helps a lot.
Hugely.
62% of Americans are retired single. I believe that the SALT deduction helps them directly. It really, really helps them because a lot of times you're in the same house, but the taxes keep going higher and higher and higher, depending what state you're in. If you have two houses and all of a sudden you have two taxes and all these other things, you have to worry about that. If you snowbird to Florida, it might not help you because you don't have any state taxes. Not snowbird, resident of Florida, you have that problem.
Yes.
All right, so Maryland has taxes on retirement. Maryland has taxes for everybody else working. That's part of the deduction. You might be able to itemize. So basically our advice is this: keep track of your expenses. There's also a separate line where you can actually take charity this coming year, like we used to when the rule first came out. That phased out. So I think it's $1,000 to $2,000. So,
and that's with a standard deduction, right, Brian?
With a standard deduction. Right. So keep track of your charities this year, your medical expenses, all of it, and just in case you can itemize, because we don't know if the IRS does these forms, right, what it's going to look like. And that's why our premise today is this is what we know. We're going to interpret what we know, try to apply it to your life. We think you got to look at this as a great way to do some planning. The SALT deduction is going to be a little bit more, and it could apply to you. Keep track of your expenses when you do your taxes. All right, so there's no tax on tips, Paul. What does that have to do? Can we start taking tips?
Oh boy, yeah. That's, if you read all the articles, that's how they interpret it, right? Is, oh, you don't have to pay tax on your tips or tax on your overtime. And that is not how we interpret it. There's certain levels to it, right? So there's certain levels, I believe, on the tip side. So it's a tax deductibility of it, right?
Yeah, but you and I can't take tips now.
No.
So the rule, what's really cool in the rule is they wrote a rule basically prior to the law being enacted. If you weren't getting tips under your normal compensation, you just can't create a new tip compensation concept. There's no new game plan of, hey, I want to call my pay tips now.
I know. Isn't that fun? That was what we sort of talked through before. Like, well, companies restructure their income and they avoided that.
And they drew a line there. But there's still going to be people who try to find a way around. There's certain industries, certain jobs that do allow tips to cover. So tips, go ahead, Paul, explain how it helps with taxes on people that get tips.
Sure. So up to $25,000 of your tips are considered tax deductible. And again, that reverts back to not that situation back again in 2029. So it's only from 25 through 2028.
And that's $25,000 if you're married filing jointly.
Right.
And you have to make less than $150,000 or less than $300,000.
$300,000 for married filed joint, right? And then $150,000 for individual.
Individual. So, single people work in the restaurants, $12,500 of their tips that flow through, that money is going to be tax free. meaning that you get a deduction against it.
Right. And that was such an interesting part too, right, of the bill, Brian, is does that really apply to so many people? Like most people who are servers, beauticians, who are living off of those tips, they're generally not in those brackets that are closer to that 150,000 level. So it's really fascinating how that.
Unless you're the owner of the restaurant and you get tips too, you might that'd be an issue there. I think the idea is this, that with a tax on tips, your W-2 that you receive is going to have a line item. When you get your W-2 next year, make sure it has the tips broken out. Make sure it has the other option, the other thing we're going to talk about, which is overtime. It's going to have to be broken out on the W-2 so you can separate and take a deduction against overtime. So how does overtime work, Paul?
Right. So overtime is also tax deductible. If you're single, it's $12,500, up to that $12,500 of overtime. If you're married and a husband and wife are both having overtime, then it's up to $25,000. And again, there's income limits that are the exact same as the tips, which would be $150,000 for an individual and $300,000 for a married file joint.
Yeah, so I've seen longshoremen, I've seen police officers run up lots of overtime. And lots of overtime, this is going to allow you to have a deduction for part of it.
Correct.
But it's going to be a separate line on your W-2, which will mean that's tax-free. How that's going to affect your payroll, I don't know yet. How it's going to affect what line on W-2, we don't know yet. We just believe we're going to pay a little less tax on the overtime. Overtime, you always feel like they're taking more tax than ever because you're at a different bracket.
Yep.
Generally, that returns to your average effective rate, which ultimately is not terrible. You usually get refunds in years you have high overtime.
Right. But again, Brian, it's not that all your overtime is tax-free. That was sort of a misinterpretation that people have now. It's only up to those limits.
$12,500 for single and $25,000 for married filing jointly, subject to income limits. Keep hearing income limits on every little side piece, their side thing we talk about. Every new idea has a little limit of time of 4 years, has limits on income. So it affects certain people, and how it applies to you is the key thing. Right.
And that's how we work with you, right, Brian? In planning, we sit down and review and see how it applies to you.
Yeah. So the main idea, if you pay a little less tax, you get to keep more.
Oh,
that's not a bad thing.
Oh, yeah.
But if we can pay less tax, can we do something else that's going to benefit us long term? And that's where the strategy of understanding the law and how it applies to you matters. And that's why the show today is called One Big Beautiful Bill and You, because it's a great time to review what's going on for you and your situation and what can you do better. Can you Roth convert? I love the Roth conversion, if you haven't heard that yet. All right, so let's hit two more. One, car loan interest deduction. What's your opinion of that, Paul?
Oh, boy. Yeah, that one seems like it's the case, which we were talking about this before, but buyers can deduct up to $10,000 in car loan interest. But here's the caveat, as long as the vehicle is assembled in the United States.
Yeah.
But $10,000 is that limitation.
That's a lot of interest on a car loan.
And that's right. It's like, what kind of, we did the math, right, Brian? What is that? A $200,000 car at 5%, that's $10,000, right?
Right. But let's say you have a car loan at really high interest.
Right.
The problem is we believe you have to itemize to take this deduction. But that's one version we saw. Then we had another one to be a separate deduction like student loan interest, and we're not quite sure on the car loan interest where the deduction is going to come.
Right. Is it going to come? Can you take a standard deduction and deduct it, or does it have to be itemized?
I'm hoping it's not part of the itemized, and I believe it's going to be that where it's a straight deduction. That's going to help lower income people a lot. In fact, that if you have a high interest car loan, that means you got to save your car statements. You got to turn that to the tax person. This is my interest I paid this year on your car loan. Right. So it could make a lot of sense. There is income limitations on that, of course, and it's only for 4 years. There's a little bit of new 529 rules. The main idea there is homeschool expenses can be used out of a 529. We're working on interpretation of homeschool co-op expenses. We haven't found out if that's part of the law yet. So there's some new deductions there. And 529 and ABLE accounts, you're able to put more money for disabled children. We like that a lot in special cases that we have.
Right, more flexibility.
And I got to hit this last one for a second here, Paul. Trump account, what's this all about?
Oh, boy, yeah.
Just real quick summary.
Quick summary, what it seems like is that for anybody born in, I believe it's 2024 through 2028. There's some interpretations that it starts in 2025 through 28.
Yeah.
But the government will almost plant a seed into an account for you of $1,000 for that child, per child. And You don't have to contribute to it anymore. You can add up to $5,000 a year. Husband and wife can contribute to that. And again, that account is tax deferred for them to use when they're 18. But that's the fun part, right? The Trump account. Isn't that funny? That's the name of it, the Trump account.
Well, the things we don't know is where the account's going to be held.
Right.
It says it's going to be invested in low cost ETFs, which sounds like it's going to be a government run account.
Right. And even funny enough, Brian, my interpretation of it as well was that it has to be in equities, that you didn't have a choice, which is really interesting.
Right. So right now, don't think we're recommending it yet, but it's something to read about, see if it applies. If you have a kid, hey, check into it, just see if it does apply to you. I would say don't overfund till you understand it. All right, so today we've been hitting one big, beautiful bill and you, just a little bit of it, the pieces that apply to financial planning. We felt it was very important to get this information out quickly to you since the bill was signed on July 4th. Very important to understand that bill, understanding the pieces of it. There's a lot of other things in there, lots of things. So this is just talking about what applies to financial planning, applying this bill to you and your financial situation. All right, Paul, thank you very much for a good show.
Thank you, Brian.
Can you believe that hour flew by that fast?
Flew by, and we got through a lot, but that's why it's so important to plan and for us to sit down and review with you.
And we do. We look forward to meeting with you. It is a great time to review. We want you to win in your retirement by taking this opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com or call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.